The realization hits with the cold precision of a ledger entry that refused to balance. After verifying the math a second time, the discrepancy becomes an undeniable reality. The $52,000 salary promised in the offer letter has withered into a take-home reality of just $41,052 annually. This sudden $10,948 evaporation occurs in total silence, absent of any formal meetings, explanatory documents, or even a courtesy warning from management. It is a financial ambush that leaves a 22-year-old staring at a $3,421 deposit with a sense of clinical betrayal. This mandatory deduction acts as a silent toll booth on a road you never agreed to travel, marking a brutal initiation into a system where the government claims its share before you can even touch your own earnings. While your meager savings account stagnates at a 0.01% interest rate, you remain blissfully unaware that any alternative strategy exists, buried somewhere within a labyrinthine tax code spanning over 2,600 pages. What remains unsaid is that the tax code functions less like a civic duty and more like a complex scavenger hunt where the prizes are only visible to those who master the map. It was never designed for the comprehension of those whose capital it extracts, but rather as an elaborate reward mechanism for the financially literate who learn to decode its cryptic logic. At this nascent stage of a career, most people simply pay the full rate, passively accepting the standard deduction through software like TurboTax. By February, a $400 refund arrives, sparking a sense of misguided thrill. In reality, that check is merely the return of an interest-free loan granted to the government for 12 months. It is the fundamental law of the W-2 existence. You do not pay what is owed, but simply what is taken. Yet, as one reaches age 24 or 25, a shift occurs. Recalling a half-ignored mention of a Roth IRA from a distant onboarding session, an account is opened online in just 11 minutes. It begins with a $500 deposit, then $1,000. The sensation of unearthing a hidden financial treasure is intoxicating, and while a discovery has certainly been made, its magnitude is often overestimated by the uninitiated. The Roth IRA functions as a pristine, tax-free vault for capital, fueled by after-tax dollars where every cent of growth remains permanently shielded from the IRS. Over a 40-year horizon, an annual contribution of $7,000, assuming a 9% average return, balloons into a staggering $2.1 million, all of which can be withdrawn without owing the government a single penny. This is undeniably powerful, yet in the grand architecture of tax strategy, it represents merely the entryway or the smallest cloakroom in a massive skyscraper. While sharing this find with a friend who merely nods without acting, one feels a sense of intellectual superiority, even as the true depth of the building remains hidden. Meanwhile, personal net worth quietly crosses the $50,000 milestone, gaining momentum slowly then moving a little faster. The inventory of write-offs expands to include a partial deduction for your phone bill and the full cost of professional development courses. Previously, the tax code appeared as a monolithic fortress designed to keep you out, but it now transforms into a complex instrument that you have finally learned to play. This brings us to the second rule of financial gravity. The code does not shift based on the size of your check, but rather the plumbing of how that money flows into your hands. As your combined W-2 salary and side revenue crest the $100,000 milestone, you enter the 22% federal bracket for a portion of your earnings. With your effective rate climbing and self-employment taxes compounding, you are essentially watching real capital evaporate into a system that offers no rebate. This necessitates a move from defense to structural engineering. Here is what that looks like at your current altitude. You form an LLC. Under this arrangement, the remaining profits, roughly $90,000, flow to you as an owner distribution rather than traditional wages. This distinction is vital because that $90,000 avoids the 15.3% self-employment tax entirely. By simply reclassifying the plumbing of your income, $13,770 no longer vanishes from your bank account every year. While nobody told you this was legal, it is a decades-old pillar of the tax code utilized by millions of sophisticated business owners. You simply hadn't realized you were a business owner yet. Even after paying a CPA $2,400 annually to maintain this architecture, the math remains overwhelmingly in your favor. This brings us to the third rule. The most expensive thing you can ever do is nothing. Inaction carries a heavy price that never appears on a formal bill. It is the silent friction slowing your ascent. Now, as annual revenue crosses $250,000, the business matures. With employees, contractors, and recurring clients, your service finally scales. The capital is tangible now, and it is gaining height. Your net worth oscillates between $300,000 and $500,000 depending on the month's market rhythm. You decide to purchase your first property, though not out of a romantic desire to be a landlord or because of some late-night investment seminar. You move because your accountant explained the mechanics of depreciation, and the sheer magnitude of the figures forces you to sit in stunned silence. The IRS permits you to depreciate residential rental assets over a 27.5-year schedule. Consequently, a $400,000 property functions like a thermal cloak, generating roughly $14,545 in annual phantom losses. These are strategic deficits that appear on your tax return without a single cent of actual cash leaving your pocket. You have reached a stage where you are now legally losing money you never actually lost. The strategy deepens by merging employee and employer contributions within a solo 401k, allowing capital to accumulate in a pre-tax vault where growth remains entirely untouched by the IRS. For those with high, consistent revenue, the defined benefit plan serves as a secondary fortress, sheltering an additional $100,000 to $265,000 annually. These structures are actuarially certified and entirely legal, long favored by physicians, attorneys, and founders. You begin treating your family as a functional wing of this architecture by hiring your 16-year-old daughter for legitimate tasks like photography or social media. By paying her $14,600, you stay below the standard deduction, meaning she pays no federal income tax while your business claims a full payroll deduction. You have successfully migrated wealth to a lower tax atmosphere. You have transferred money to your child, tax-free at her level, deductible at yours. Navigating these waters requires a seasoned CPA to chart the optimal course for your specific structural needs. One of the most elegant maneuvers in this playbook involves IRS Section 280A, commonly known as the Augusta Rule. This provision allows an owner to rent their personal residence to their business for up to 14 days per year for legitimate business meetings. The beauty of the strategy lies in its symmetry. The rental income remains completely tax-free for the homeowner, while the business claims the entire payment as a deductible expense. It is a rare dual-benefit window that stays open for exactly 2 weeks. This framework is far from exotic. In fact, it is the standard blueprint drafted by any serious business attorney worth their salt. It is the same quiet machinery that the neighbor in the modest, unremarkable house has likely utilized for 15 years, aided by a very expensive accountant and perhaps a subtle, knowing cough to keep the secret. At this altitude, wealth undergoes a fundamental metamorphosis where it stops living in a personal name and begins residing in structures. These entities act as sophisticated vaults designed to receive, hold, and deploy capital with absolute minimal friction and peak legal armor. The transition from a person who owns assets to a person whose entities own them is not merely a semantic pivot. It is a profound financial and generational shift. Once a net worth crosses the $20 million milestone, something truly strange happens. The individual effectively stops earning. Instead of triggering taxes, you simply borrow against your assets. By utilizing a securities-backed line of credit, or SBLOC, you pledge your investment portfolio as collateral to draw cash at a modest 4% to 6% interest rate without liquidating a single share. This maneuver bypasses capital gains events entirely, ensuring no income is recognized and not a penny in tax is owed. Because the IRS cannot tax borrowed funds, you effectively fund your lifestyle through these loans while your underlying portfolio continues its undisturbed climb. It is a strategic arbitrage of the tax code, where the cost of debt is dwarfed by the rate of market growth. This is not some clever loophole but basic arithmetic, the same formula the wealthiest American families have used for generations to thrive without ever seeing a W-2. The ultimate rule is clear. The wealthy do not seek to earn more. They reclassify what they receive. Once your net worth hits 9 figures, you stop consulting financial advisors and begin meeting with an estate attorney. Beyond technical entities, charitable foundations serve as a sophisticated framework for wealth management, offering an immediate tax deduction while excising assets from the taxable estate. This isn't merely about altruism. It is about building a reputational shield, an enduring civic facade that allows a family to maintain total control over fund deployment across generations. This is not a moral judgment, but a clinical description of how philanthropy functions as a strategic cornerstone. Consider the case of a 74-year-old investor with a $60 million portfolio. Decades ago, those index funds, real estate holdings, and early equity stakes were worth just $4 million. Because the core positions were never sold, the $56 million in appreciation has never triggered a single dollar of capital gains tax. The growth was simply deferred, allowed to compound undisturbed by the friction of liquidation. Now, as the owner passes away, we see the ultimate execution of the plan. Here is what happens next. Your heirs inherit the portfolio. Upon the moment of death, Internal Revenue Code Section 1014 triggers a financial metamorphosis. This provision, a staple of the tax landscape since 1921, facilitates a stepped-up basis where the cost basis for capital gains calculation resets to the fair market value on the date of passing. The original purchase price of $4 million is discarded. It is replaced by a $60 million valuation. Consequently, the $56 million in appreciation amassed over 40 years is permanently and legally erased from the tax record. These gains are not merely sheltered or deferred. They are treated as if they never existed at all. While the government was theoretically owed taxes on decades of compounding visible on every brokerage statement, that ledger is wiped clean. If your heirs sell the entire portfolio the following year, they owe nothing. Not a dollar, not a percent. They receive the full $60 million, and the tax bill the government waited for decades to collect never arrives. The ultimate secret, the most formidable tax maneuver in the history of the American Republic, is not found within a complex trust, a specific corporate entity, or a clever election. It is the simple, profound act of dying while holding the right assets. Somewhere right now, in an apartment thick with the scent of cheap takeout and raw ambition, a 22-year-old is opening their first real paycheck. They do the math twice, realizing the net figure fails to mirror the promise of their offer letter. They are momentarily confused, then annoyed, but eventually they move on just as everyone moves on. No one told them that this specific confusion was actually a hidden door. No one explained that the financial system operates under an entirely different set of rules for those who learn to ask the right questions. Instead of dwelling on the withholding, they set the pay stub aside and open a laptop to finish a freelance project due by Thursday. They cannot yet grasp that this precise moment of earning outside the confines of a W-2 is the first crack in the wall of conventional employment. It is the opening line of a 40-year odyssey that ends not with a paycheck, a bonus, or a standard retirement account, but with a stepped-up basis at death and a tax bill 40 years in the making that simply never arrived.